Margin of protection in these cases varies greatly, so that industrial bonds. Industrial bonds include the obligations of all manufacturing and mercantile companies and miscellaneous companies of a private character. They form a class quite distinct from railroad bonds or public utility bonds. First, safety of principal and interest. The safety of industrial bonds, in common with the safety of all forms of investment, depends upon the margin of security in excess of the amount of the obligation. In the case of industrial bonds, the amount of this margin is not always easy to determine. Even when determined, the rule is difficult of application because a margin which may seem insufficient from the point of view of fiscal valuation may be satisfactory when considered as the equity of a working concern. The indications most to be relied upon in estimating the safety of industrial bonds are as follows. A. Value of real estate. The first point to be determined in considering the purchase of an industrial bond is the value of the real estate upon which it is a first mortgage. If the appraised value of the ground, irrespective of the buildings and machinery upon it, is greater by a substantial sum than the amount of the bond issue, the obligation is practically a real estate mortgage. In such a case, which possibly is slow, that is, secured by an asset difficult to realize upon, the safety of the bond can hardly be questioned. In judging a bond upon its real estate value, it is not always safe to take the cost price of the land as shown by the company's books because frequently the cost upon the books is artificially raised by payment having been made in securities whose market value is less than par or in other ways. As stated above, judgment should be based upon the appraised value of the land. If the bond meets this test satisfactorily, the prospective investor may feel reasonably sure that the safety of his principal is not in question and may buy the bond without anxiety if it satisfies his other requirements. On the other hand, if the bond only partially meets his test and it appears that some part of its value comes from plant and equipment and from the strength of the company as a working concern, then it is necessary for the investor to consider carefully several other factors. B. Net quick assets. The balance sheet of every industrial company can be divided horizontally into two parts. Its assets are of two kinds: property assets, which are fixed, and current assets, which are fluid. Similarly, its liabilities are of two kinds: capital liabilities and current liabilities. It requires no very extended business experience to pick out the items which make up these totals. Plant and property assets are usually lumped together under the head cost of property. Current assets include inventories, bills and accounts receivable, agents' balances, marketable securities, and cash on hand and in banks, everything, in short, which can be quickly converted into cash. On the other side of the balance sheet, capital liabilities are easily determined. They consist of the par amounts of bonds and stocks outstanding. Current liabilities comprise bills and accounts payable, including borrowed money, payrolls, and interest and taxes accrued but not due. The real strength of every industrial concern is to be learned from the figures relating to its current accounts. Property assets and capital liabilities are not of the same significance. If the cost of plant and equipment as shown by the books exceeds its real value, the market usually makes the necessary adjustment by putting a price less than the par upon the bonds and stocks. No such process is possible in the case of the current accounts. If the current liabilities exceed the current assets, the company shows a deficit, whatever its surplus may show on the books. On the other hand, if the current assets are greater than the current liabilities, the company possesses a working capital represented by the difference between the two and known as net quick assets. There are three things to consider in connection with net quick assets. First, the proportion between current assets and current liabilities. To put a company in good shape, its current assets should be at least twice as great as its current liabilities. 2:1 is a fair proportion, though some companies show as much as 6:1. The stronger a company is in this proportion, the better. Secondly, the proportion between net quick assets and bonded debt. The bonded debt should never exceed net quick assets, except when the company possesses real estate, in which case 2/3 of the real estate value plus the net quick assets should cover the bonds. Some companies do much better than that. One prominent company in this country, although it possesses real estate of considerable value, has agreed in the indenture securing its bonds to keep net quick assets at all times greater by a substantial margin than the amount of bonds outstanding. Thirdly, the proportion between net quick assets and the surplus as shown in the balance sheet. If the capital liabilities exactly balance the property assets, it is plain that the surplus will exactly balance the net quick assets. If the surplus is smaller than net quick assets, it is usually a sign that capital liabilities have been created to provide working capital. Opinions differ as to the wisdom of this course. Generally speaking, it is better to provide working capital by means of a stock issue than to depend upon the banks for accommodation. The exception to this rule occurs in the case of companies that require a great deal of working capital for part of the year and only a little at other times. If they have the best banking connections, such companies may be safe in depending upon their banks to carry them. But if they do so, they should have no bond debt or other fixed indebtedness which would prevent their paper from being a first lien upon their entire assets. If working capital is to be created by the issue of capital liabilities, it is much better that it should be done by stocks than by bonds. The ideal method, however, is to provide only such an amount of working capital at the organization of a company as is necessary for the conduct of its business, and then, as the volume of its business grows, to accumulate the additional amount necessary out of earnings, refraining from the payment of dividends until the fund is complete. Before leaving the subject of net quick assets, it is well to note the importance of the figure showing the actual amount of current liabilities. If a company has outstanding large amounts of bills and notes payable, it occupies a vulnerable position. Inability to renew maturing notes was the cause of most of the industrial failures of last year. C. Net earnings. The amount of net earnings is of great importance in estimating the strength of an industrial company. The figures for a number of years should be examined to determine whether the earnings are increasing or decreasing, and to discover whether or not the earning power of the company is stable. This will depend largely upon the nature of the article which the company produces or trades in. If its product enjoys a steady demand at a fairly uniform price, it is justifiable that some of its capital should be in the form of bonds, but if its earnings are subject to violent fluctuations due to rapid changes in the price of its product, there is little justification for conducting the business on borrowed money. In this connection, it should always be considered how greatly a falling off in gross earnings will affect net earnings, and the proportion between net earnings and fixed charges should be carefully noted. In order for an industrial bond to receive favorable consideration, the average yearly net earnings of the company should amount to about 3 times the annual bond interest, taxes, and sinking funds. The greater the protection is, in this respect, the better. D. Form of issue. The form in which an industrial bond is issued is a matter of some importance. If the principal of the bond does not become due for a number of years, there is danger that the property will depreciate so far in value as to leave the bond without sufficient margin of protection. There are 2 ways to overcome this difficulty. One way is to establish a sinking fund, which will retire a certain proportion of the bonds by lot each year. Another way is to issue the bonds in a serial form with a definite installment maturing every year. In either case, the annual sinking fund or annual installment should be greater than the probable depreciation so that the margin of security will be constantly increasing. E. Management and control. No question is of greater importance in estimating the strength of an industrial company than the reputation of the men in charge. The ability and integrity of the men who control the policy of the company and the efficiency of the operating officials are the principal factors in the success of an industrial undertaking. Vacillating policies, weakly executed, will ruin the most promising enterprise. This is particularly true in the case of small companies. Every man of business experience will understand the importance of this factor and be guided by it in the selection of industrial securities. Based upon the foregoing considerations, it is of interest to inquire what degree of safety really attaches to the average industrial bond. How far does it meet the foregoing requirements? The question is difficult to answer. Industrial bonds vary greatly in point of safety, some issues possessing great strength and others being highly speculative. No general conclusions can be depended upon, and the investor is forced to consider each issue upon its own merits. Second, rate of income. The average net return upon industrial bonds is probably higher than upon any other form of funded corporate obligation. This constitutes one of the chief advantages of industrial bonds. Third, convertibility. It is impossible to make any general statement in regard to the convertibility of industrial bonds. Some industrial bonds, notably the larger issues of well-known trusts, command a broad and active market. Such bonds can be sold in large amounts at almost any time without seriously affecting the price. On the other hand, small underlying issues of such companies, usually high grade in point of security, or the obligations of smaller companies, are almost as unmarketable as real estate mortgages. Between these two extremes, all varieties of industrial bonds are to be found. The degree of convertibility which a security possesses is usually a matter of some importance, and the investor should make a careful examination of each bond in this respect. Fourth, prospect of appreciation in value. To what extent a bond may improve in security during the time that an investor holds it is of little importance unless the improvement be reflected in the market price of the bond. Only so can the investor take advantage of its appreciation in value. In order for the improvement in security to be reflected in market price and thus add to the principal invested, it is necessary that a bond should possess a fairly active market. For this reason, the industrial bonds which hold out the greatest promise of appreciation in value are the larger, more speculative issues which possess the greater convertibility. The purchase of such bonds frequently results in substantial profits. Fifth, stability of market price. The 4 points above touched upon, safety, rate of income, convertibility, and likelihood of improvement in intrinsic value, are all inherent characteristics of every bond. The likelihood of favorable or unfavorable fluctuation in market price is largely external in its nature and depends upon general financial and business conditions. As a class, industrial bonds cannot be said to possess much stability of market price. Some of the smaller issues enjoy a fictitious stability because of their inactivity, but generally speaking, industrial bonds are subject to wide fluctuations in accordance with changes in the business outlook. The foregoing is a summary, necessarily brief and imperfect, of the main points to be considered in judging the value of industrial bonds. The question remains whether such securities are desirable for the investment of a business surplus and of private funds. Except in special cases, industrial bonds are not suitable for a business surplus. It is impossible to find an industrial bond which combines all the characteristics necessary for that purpose. The requirements are great safety of principal and interest, a relatively high return, ready convertibility, and stability of market price. Many industrial bonds can be found which combine 2 of these requirements, some even which combine 3, but the full combination, if it exists at all, is unknown to the writer. In addition, the principle of distribution of risk should prevent one industrial company from investing its reserve funds in the securities of another industrial company. For private investment, the case is somewhat different. A man of good business judgment who desires to obtain a high yield for which he is prepared to sacrifice something in the way of convertibility and prospect of appreciation in value may buy the underlying issues of strong companies with every confidence in the safety of his principal. Again, the investor who wants a high yield and quick convertibility, who is prepared to take a businessman's risk and to sacrifice stability of market price, may make a large profit by buying second-grade industrial bonds. No investor, however, should deceive himself with the idea that any industrial bond will satisfy all the requirements of the ideal investment. Public utility bonds. It was